Yes, but with this, let's move on and let's also welcome Gautam Duggad, Head of Research of Institutional Equities of Motilal Oswal, joining us on the show right now. Hi, Gautam. Morning. Good to be speaking with you. And firstly, this 25% tariff announcement, help us understand what does it really mean for the equity markets? Because, Gautam, this is coming at a time when we were going through not a great set of earnings. The debate regarding the expensive valuations was still on, and no respite in terms of the tariff as well. Do you believe it could dent the profits of the companies and select sectors in a bigger fashion, and there could be more pain?
Hi, good morning. Thanks for having me. Yes, and so far as tariffs is concerned, this news has been there for 3-4 months now. I mean, the reaction of the market is very muted, just 0.5% down. So I don't know, how to look at it in the short term because a lot of things are still to unravel. I'm sure Indian government will also react. We have not seen the last of it yet, in my view, given the way how US has repeatedly changed its stance on this matter. So let's wait it out for a few days and see if there are more twists and turns. Sector-specific impact will obviously be there, depending on which sector gets hurt more. We don't cover textile, but clearly textile seems to be bearing the brunt of it. We'll have to see what they do to pharma, because as of now, pharma is not impacted, metals is not impacted, financials is not impacted, consumer is not impacted, IT is not impacted, cement is not impacted. So there could be some indirect impact that will accrue to some of these sectors. Very difficult to pencil in a specific quantifiable measure that this tariff has happened and therefore XYZ% is the impact at the earnings and this is how the PE will contract. So that thing will evolve as we move forward. Clearly, 25% seems to be slightly higher than what most people have been working with. But market is taking it in its own stride, given that this has become too recurring an issue now. And market has moved beyond some of these exogenous factors. And people are focusing on stock where things are in their control and looking at portfolio from that point of view. I don't agree with the point that earnings have done nothing. So far, 132 companies in our coverage have reported numbers. It's 10% growth, which is in line with expectations. Yes, the forward earnings have got cut by 1.5%. So while we were expecting about 11% Nifty EPS growth for FY26 when the quarter began, when we published our preview 3-4 weeks back, as we speak, that 11% growth has come down to 9.5%. But there is too much of a narrative that earnings are bad. If you look at sector by sector, stock by stock, and then aggregate it, at aggregate, the numbers are in line with expectations.
A lot of food for thought there, Gautam. But, like I was discussing with earlier speakers as well, that it's actually great news for equity markets. While there may be a taco and Trump may chicken out and one is keeping fingers crossed for that, at least equity markets know what's the worst case scenario to work with, which is 25%. And one can already see that stability kick in. That gap down got a little bit covered. Of course, it's expiry day as well, but we're already down just 0.5%.
Aisha, I mean, one thing which we have learned repeatedly in the markets over the last decade and a half is the only thing that the stock markets respect over a period of time is corporate earnings. FY20 to FY24, you had a 20% plus corporate earnings growth. In fact, 30% for Nifty 500. You saw very phenomenal, stock market returns, depending on which index you look at. Last 1 year, earnings growth has been absolutely tepid. FY25, you saw flattish earnings in Nifty, 3-4% growth in broader markets, and markets have done absolutely nothing. I mean, if you look at point-to-point returns of last 12 months, we have gone all over the place and ended up nowhere. So clearly, all these factors, Trump, tariffs, geopolitics, wars, other headwinds, they will come and go. The only thing which will matter for the market from a 1 to 3 year perspective, it will be the corporate earnings. And we are hopeful that this year will be slightly better than last year. Plus, government and RBI have taken series of measures on income tax cuts, rate cuts, liquidity. So let's see, I mean, after a couple of months, if the tailwinds from those steps that the government and RBI have taken, if they manifest in better high-frequency indicators with the advantage of a very good monsoon again and festive season beginning to start from September. So I would think that while valuations are expensive for mid-caps and small-cap indices, the growth is also there in mid and small-cap. I mean, last year, while the broader markets grew at 3%, mid-caps in earnings in our coverage grew at 10%. This year, we are penciling in 8 to 10% earnings growth for large cap, but 20% for mid-caps. So in our model portfolios, we have further increased the component and allocation of mid-caps from 24% to 31%. Consequently, obviously, we brought down the weightage of large caps in our model portfolio across sectors.
Right. Okay, the latest comment now coming in from Donald Trump. He's saying, I don't care what India does with Russia. They can take their dead economies down together. For all I care, have done very little business with India. Their tariffs are too high, among the highest in the world. Likewise, Russia and the USA do almost no business together. Let's keep it that way and tell Medvedev, the failed former president of Russia, who thinks he's still president, to watch his word. He's entering very dangerous territory. This, of course, now seems to be getting more a political battle with egos thrown in. And, this is going to take some time, definitely, to resolve. But I think it's more about oil and what really comes out of that, because that is what is going to impact us. That's where things stand as of now. And that's the other thing, right, Gautam? Because forget the overall exports and what the tariffs, should they come in at 25% to various sectors, this oil risk, where things settle down with Russia, that seems to be a bit of a niggling worry, because obviously it's going to have a bearing on marketing margins, etc. for us.
Yes, absolutely, Aisha. That's one of the most important commodities for us, and it has bearing on multiple macro parameters: current account deficit, inflation, and obviously, consequently, the interest rates in the economy. So we'll have to keep a close eye on where the crude oil settles. But last 10 years, barring that 1 or 2 month period when crude oil spiked up to 130, 140 during the Russia-Ukraine crisis in early 2022, most of the last 10 years, we've seen oil behaving in a very nice and a tight range. Which has helped us at the margin insofar as macro parameters are concerned. So yes, we'll have to keep an eye on it, but very little we can predict and do about it, till the time things settle down.
But also help us understand that which sectors will now may need a relook in terms of the earnings projection, because for now the chemicals, textiles, they are taking a bit of a hit on the stock prices as well. What's your analysis?
So sectors which matter very little to the overall earnings pool are getting hit. The big sectors, 3 or 4 big sectors which contribute almost 65 to 70% of the earnings pool, which is financials, which is IT, consumption, auto, and to an extent utilities. They are not that directly impacted by this tariff-related madness, and which is why you're seeing a very mature and a calibrated reaction by stock markets. Our earnings will be a function of 2 or 3 important things: how the domestic economy behaves as the after effects of rate cuts and income tax cuts, along with improved liquidity and good monsoon, they take shape. Whether we see a pickup in high frequency indicator early September, October. Does consumption revive? Because after a long time, government has changed its stance and started focusing away from capex towards consumption. Consumption has almost been dead insofar as low ticket items are concerned. In fact, in our model portfolio, we've made consumer staple zero first time in last 10 years. Our entire weight in consumption is allocated towards consumer discretionary. Third, sectors, particularly this quarter and this year too, FY26, smaller sectors are driving whatever 10% growth that we are talking about. So, for example, in this quarter, we are expecting private banks to report an earnings decline, PSU banks to post flat numbers, IT obviously is done, 5-6% growth, which is what was expected, consumer zero growth, auto a slight bit of a decline because of a decline in some of the heavy OEMs like Tata Motors, Hyundai, and Maruti. So whatever 10-11% growth that we are penciling in for this quarter as well as the full year is being led by EMS. Cement obviously will have a rocking quarter as well as year after a long time, but it is well expected. Then you have pharma, which is going to post double-digit earnings, and then little bit of consumer durables and some other smaller sectors. All the big sectors are going to be very, very muted, both for this quarter as well as for the full year, because the big tailwind in the asset quality that we have enjoyed in the financials between FY18 to FY25, when the backing BFSI profit pool in our coverage universe went from 50,000 crores to almost 5 lakh crores in 7 years. Now that seems to be settling at 10-12% growth, which is broadly converging with your underlying credit growth in the economy. And consumption, till the time it doesn't pick up, you have this very peculiar problem where the 2 big sectors, banks plus consumption, and at the margin, if you also add large cap IT, these 3 sectors put together account for 55-60% of the profit pool, and they are not growing beyond 7-8%. So till the time one of this sector picks up earnings, the index earnings are going to look very, very, maybe high single digit or low double digit. The real alpha, therefore, will accrue from stocks picking, and within sector also the dispersion of earnings growth is very high. So, for example, if you were positive on consumption for last 4 years and you were allocated in HUL and ITC, you made no money. Similarly, in IT, if you're positive and you are allocated towards large cap IT, you massively underperform. So this is, ish as may sound, a pure bottom-up stock pickers market. And therefore, while your sector call can be right, unless the stock call is right, you end up underperforming even then.
Interesting points made there, Gautam, but thank you so much for taking